If you want to be a profitable day trader in 2024, you need to understand daily bias. I see so many traders who get the daily bias right, but don't know how to formulate a game plan around it. In this video, I'm going to share the keys to daily bias, the process, the mindset, and how to trade properly. So grab your notebooks and let's get started. Hey everyone, welcome back for another video. This one is going to be a simple guide to daily bias. Now, I see a lot of people getting daily bias wrong. It shouldn't be as hard as people make it seem, but I'm hopefully going to put together this simple process for you guys to go through and kind of set your minds at ease when you're either taking a position or trying to formulate an idea in the market. And I think that some of the biggest issues that some people have around daily bias is, how do I create a daily bias, first of all? How do I know it's the correct one? And how do I be confident enough to take trades with that daily bias in mind? Okay, so let's first get into, what is daily bias? Now, as a day trader, we are really only thinking about, what is going to be our opinion or direction for the next 24 hours. That's our daily bias, right? And that's what makes it a daily bias. If we were trading the weekly candle, right, it would be a weekly bias, which is not what we're going to cover here. I mean, it's very similar. We're just really trying to figure out what's going to happen in the next 24 hours as a day trader. So again, everybody participating in the market has an opinion, right? But only one is right. The market's either going to go up or it's going to go down. So your daily bias is your opinion on whether the market is bullish or bearish. If you're relying on other people to help formulate your bias, you're doing this wrong. Now, I'm just speaking from experience. When I first started getting into trading, obviously, I didn't know what I was doing. I didn't know how to read the markets properly. I didn't know how to stick to my game plan. And I know a lot of you out there are struggling with the same things because every up-and-coming trader deals with these same struggles. I don't think there's any trader out there that's made it that hasn't gone through this struggle. If you find yourself creating a bias and then questioning yourself, obviously there's something going on there. It's either your lack of experience or you're just not confident enough in your opinion of the market. Right? So there's many different things that are factoring into our opinion of the market, right? Are we hearing different news headlines in the financial space that's driving our opinion of the market, right? And you kind of notice it in cycles where you get this hot name or pair and now everybody's all over it. And you're essentially relying on, let's say if you were part of the GameStop saga and you listened to all the news headlines, you got in and you took that trade and it went your direction, but then it went against you. Well, really, you're kind of relying on other people's opinions of that name rather than doing your own due diligence, researching that name, doing your own analysis, and growing into an independent trader. And that's our goal as a trader. And that's it's going to alleviate a lot of pressure. It's going to alleviate a lot of confusion when it comes to sticking with our daily bias, because I know that there's so many traders out there, and I've seen it personally of even students of mine where they have one daily bias going into the day, and then all of a sudden, when they get to the charts, they see something that, is possibly faking them out. The market's going the opposite direction, and then by the end of the day, right, if they had just stuck with their initial analysis, they would have been correct. Okay? So one of the first mistakes that many traders make is not knowing what is required to form a proper daily bias. Right? The second is not knowing how to trade in agreement with your daily bias. Right? So there's many things that go into formulating a daily bias. We can't just come to the markets with zero experience, expect to create an opinion of the market when we don't know what we're looking at. Yes, you can have an opinion of the market, but is it going to be the right one, and are you going to be confident in it? If you are lacking experience, right, you're always going to have an opinion of what the market's going to do, but is it the right one? And if it's not, are you actually learning from that process? If you struggle with decision making while trading, many of your struggles can be fixed through understanding daily bias and confidently trading in line with that idea. So this quick guide is going to help you analyze the markets properly, form a bias, and then trade in line with that idea. So let's dive into, what is daily bias versus narrative? Everybody kind of somewhat assumes that the daily bias is the narrative, and that's entirely not true. Okay, so are they the same thing? Absolutely not. So while biases are the opinions of the individual traders, the narratives are the storylines behind why a market is moving. It's possible to have a bias without understanding the narrative. In fact, most traders will have a bias regardless of the narrative. I.e., an example, I think X will trade to higher prices while the narrative suggests otherwise. All right, how you read the narrative is essentially what drives your decision to create a bias. Now, this guide, everybody should know by now that I'm an ICT trader. I use his concepts, but all those tools help me create the narrative behind, why the market's moving a certain way. It's giving me data. It's giving me feedback on, if we run out an old high and then reject it. Obviously, that's part of the narrative that I have to factor in. If I was trading a different technical tool, let's say if I was trading Bollinger Bands or MACD or stochastics or RSI, you're using those indicators to help you paint a picture behind what's going on. All right. Now, based on your analysis of those technical tools, that's going to create your bias. Now, you could possibly get the narrative wrong, yes, and we get it wrong. I definitely get it wrong at least 40 to 50% of the time. That's just part of the game, okay? But the narrative behind why a market is moving is so important. Now, if you are, I guess we'll get into the downfalls of reading a narrative, okay? But again, using all those technical tools, premium discount, dealing ranges, Fibonacci retracements, et cetera, displacement, order blocks for value gaps, breaker blocks, those are all painting the narrative behind the market, okay? And then based on how that market is operating, how that price action is forming real time, that's going to help me paint my daily bias, all right? So things to consider. Obviously, stop listening to other people. I had a really hard time getting my head wrapped around this because even when I was studying ICT in his private mentorship, I would have to essentially wait for his weekly analysis to come out before I could even form an opinion. My biggest step in increasing that learning curve and actually taking the necessary steps required to become an independent thinker was completely shutting off all that noise. Because over time, and even over the course of 3 years, 2 years, whatever it was, of him releasing weekly updates and weekly analysis, I noticed that he got it wrong at least 30 to 40% of the time. So what made me more comfortable was actually formulating the ideas on my own and implementing that in the market. Because if I had to rely on somebody else's analysis, right, I'm relying on their bias to provide the direction for me. And I'm never going to get to the point where I can create that bias on my own or read the narrative on my own. So, I think stepping away from other people and, not listening to them at all. I was just on a call for a mentorship with one of my good friends. I hopped on in his room and he had mentioned that he had 2 students that were trading the same system, but they had different, entries. So one was going short and one was going long. And I was curious to know, I didn't ask them, but my curiosity would pique and try and figure out, well, if I know that this person is doing one thing, am I confident enough to hold my trade idea regardless of what that other person thought? So if I was going to go short and I see somebody else going long, right? How is that going to impact my trading? Am I going to close? Am I going to add? Am I just not confident in my trade idea where somebody else's opinion is going to affect my opinion of the market? That was a huge jump that I had to take was, stop listening to everybody online. Don't even listen to me when it comes to analysis or anything like that. Yes, you can educate yourself, and that's kind of what I'm trying to do in this video itself, is educate you on how to create your own daily bias. Stop listening to other people's daily biases. I see a lot of Twitter threads. People, it's great that people are posting their weekly analysis coming up for the week. But again, do you really want to rely on somebody else releasing their weekly outlook? Some of them are great, some of them are extremely detailed. But if you want to become an independent thinker, and if that person just all of a sudden stops posting, well, now we can't operate in the market because I'm now relying on this one person to give me their bias. All right, so learning how to detach from other people and learn how to think on your own and create your own bias is so important. Like, that is a major step that you all should be trying to take when it comes to learning. There's nothing wrong with following along with somebody for a couple months, whatever the case is, but you're gonna learn so much faster if you just take what they have to say and then go and try and do it on your own. All right, there's theory and then there's execution. I always mention that. Yes, I can provide you the theory, but when it comes to executing, I'm not sitting in the seat with you, and I'm not going to create your daily bias. I don't want to influence you and sway you or even give you a daily bias. I want you guys to learn how to do that on your own, right? And you would probably want to learn how to do it on your own, right? That way you're not relying on some random person online giving you their opinion of the market. All right, this is going to nurture independent decision making, right? And speed up your learning curve. So understanding your technical or fundamental edge, and it can be either or. If you don't understand your technical edge, right, it's going to cause a ton of problems. If you don't have an edge, you're not going to know how to read the markets properly. My edge comes not just from one specific ICT concept. It comes from understanding the majority of them. I don't understand them maybe to the minute detail, but I understand them enough to paint the whole picture together. I understand liquidity pools enough. I understand displacement enough. I understand fair value gaps enough. I understand the dealing ranges enough. And that just came through reps in the market. Now, as it relates to any other technical edge, whatever it is, and I'm just speaking from experience because I went through a period of, I don't know, 5 to 7 years of studying all these different technical tools, right? And maybe it was MACD, maybe it was RSI. I was actually studying those things, and I actually knew people that were trading those things profitably along with just regular price action, you know, outside bars, pin bars, things like that, whatever you want to call them, morning stars, you know, they're all repackaged analysis terms. But if you don't put enough reps in, right, you're not going to understand how to read that market properly because you just don't know how that market's actually going to react once that technical edge appears. So for me, you know, I'm painting a full picture based on many different things, you know, fair value gaps, premium discount dealing ranges, order blocks, breakers, right? Market structure, literally everything is giving me the narrative. And then from that narrative, I'm creating a bias. So, you know, after I have that bias, right, I'm going to try and trade that bias, but I always have an invalidation level. And if you guys had followed me at all on Twitter, you know, a couple days ago, I mean, it might have been last week, where I had posted a trade idea in the dollar CAD, and my daily level was violated. Once that daily level is violated, I'm not going to keep trying to go back in that market and trade my daily bias because I had a level in mind that, if I was correct, should never have traded to. Okay? And I think having some type of validation is so important because, let's say, if this is for people that have a daily bias and they're extremely stubborn with it, where the market is obviously showing its hand to you, it's telling you that you're wrong, but you're so stubborn and you think that the market is going to go a specific way that you're just going to get killed, right, as it's going against you. And, you know, I think that's something that the market plays upon. Like, just thinking back to some of the historic moves that we've seen in, I don't know, crypto or GameStop or, you know, Bed Bath & Beyond. I don't know, some of those wild names that, you know, obviously gets traded off of hype, right? If people don't have an invalidation of where their trade is no longer correct, now they're just really forcing it. And I saw a lot of people on my timeline. I saw people that I knew personally that were saying, you know, GME to the moon, GME to the moon, when everything technically is telling them it's going to go lower, right? When market structure is shifting lower, order flow is pointing lower, sentiment is at all-time highs. So you have all these things fighting against you, and the only thing that's keeping you in that trade is your stubbornness to stick with your bias. All right, so I always have an invalidation level. And then I have levels to keep in mind where, you know, if price does start turning around, I want to see something that is going to show me that the order flow is changing to my direction to line up with that longer term bias that I have. Okay. So again, the daily bias, we only care about what's going to happen the next day. So, you know, did we purge yesterday's high and then retrace and close back inside the range? That is very telling in itself. Okay. So if we purge that high and we close back in the range, that is a lower time frame turtle soup. All right. or if we displace and then we leave a fair value gap, and then we trade back into that fair value gap, that is also very telling. We have to understand, what level we're trading at going into the next 24 hours. Because if we're trading into a daily fair value gap, before or after a high impact news event, and everything else is lining up bullishly, let's say our market structure is lining up bullishly, everything is pointing upwards, and we're trading inside of a bullish fair value gap, but prices are going lower. And I'll give you guys an example that I called out in Telegram today, in fact. But we just have to understand that we have to stick to our bias, and those short-term intraday fluctuations should not be throwing us off unless we have that invalidation level that's breached. So I always have an invalidation level, and it's typically on the daily time frame, because if you get caught up and have an invalidation level on your intraday time frame, it might get you caught up in trying to flip your bias and then go the opposite direction, when at the end of the day it might close up in or down in your original direction. Okay, so I don't allow short-term fluctuations in the market to deter me from sticking with my bias. Okay, and I see it a lot. I dealt with it a lot. I had to go through that experience of having a bias, seeing price go against me one direction, me trying to flip my bias, and then by the end of the day, right, if I had just faded that move, I would be up massively. And I'm gonna kind of show you guys an example of what I experienced, and how you can possibly avoid some of those same issues. So I have a 6-step process to my daily bias. Right, first of all is gonna be the draw on liquidity, and maybe it's just the previous day's high or low. Maybe it's previous 3 days high or low. Maybe it's a previous week's high or low, or month high or low. Or maybe it's maybe it's an imbalance that needs to get rebalanced. It could be a candle that doesn't have a wick on one side. I use those a lot in my weekly analysis. Like a lot of times, and this is something that you guys can study, is if the week opens up and it trades one direction just straight off the open, at some point it's very likely, I would say 70 to 75% of the time, very, very likely to trade to the other side of that weekly open. So having the draw on liquidity doesn't mean that we have to hold to the full target. Okay, that just means that we have somewhat of an idea of what direction this market might go in the next 24 hours. Okay, because not every time you're going to hit your final target. We just have to have an idea, and it's basically a magnet on price on which direction is more likely to draw price to. All right, 2 is determining market structure. Do we have higher highs, higher lows, or lower highs, lower lows going into the market? Are those highs or lows being respected or rejected? We'll get into that on some of these next slides. Gauging order flow. All right, so gauging order flow, obviously, when big orders come to the market, you're obviously going to see them. They're huge footprints in the market where prices are typically one-sided. Maybe we'll come back in, refill that level, and then trade away from it again. Just understanding which direction the market is balancing towards. So, if we have a huge bullish displacement and then we just see a retracement into it and then another push away from it, we obviously know that institutional order flow is pushing us higher. And now on a daily time frame, it's much easier to read because we're basically just dealing with open, high, low, and close, where the open and the close are the most important prices. Obviously, if we have a daily close that's below the open from the previous day, right, we know that the market's somewhat bearish. But we have to, factor in all of our different tools that we've learned. Mine, obviously, is ICT related tools, but that doesn't mean that you can't use other tools and take the same process and, run with it. It's basically, a daily bias is an opinion, right? You need to have an opinion if you're going to trade a market. I'm just giving you guys the keys to formulating that opinion and being confident enough to stick with the opinion, because that's where a lot of people mess up, is the confidence in their trade. Am I going to be shaken out by somebody else's idea, or am I going to be shaken out by price action that goes adverse to my specific daily bias? All right, so number 4 is factoring the news, right? Do we have upcoming news that maybe the market's going to consolidate? Maybe we have NFP weeks, or FOMC, or CPI. These are things that you just have to study and you have to get experience with. A lot of times you're going to notice on FOMC weeks where there's a rate decision that Monday and Tuesday are pretty terrible, crappy days to trade. That just comes with experience, right? So we have to factor in the news, obviously, and then, is there a macro narrative that we can trade? And I keep bringing up this example because it's pretty recent and that comes to mind. I've been through a lot of different experiences when it comes to macro trades, Fukushima power plant exploding, whatever the case is, the Eurozone crisis that happened a long time ago, Brexit, those are different things that are obviously going to affect how the market's moving. But I would say the most recent one that's pretty easy to see is when, Ukraine got into war with Russia. So when they went to war, you can check the euro dollar chart. It was downtrending for a solid year and a half, 2 years. Okay, that's something that you just cannot avoid. Cannot avoid analyzing those headlines and understanding that some of these macroeconomic factors play a major role in how currencies are going to trade. A lot of people say, "Oh, news has nothing to do with markets." I don't buy into that. Like, I trade the news, obviously. I don't look at it so black and white because obviously some things can be baked into price and some things are already priced in. Like maybe all these rate cuts are already priced in, or maybe the fact that we're not cutting rates for a while is already priced in. So these are all things that we have to factor in. But it's only one piece of this whole daily bias flowchart, right? These are all things that we need to have in place when we're trying to create a daily bias. So mining the time, obviously, is going to be weekly profiles. Now, I don't care if you're an ICT trader or not, right? These are things that I've just studied over the years. If you just understand that a weekly range has specific days where there's going to be volatility injection, there's also going to be a weekly range target that's met. Obviously, that is going to cause an intra-week reversal, or that specific trading week is going to be capped out, basically. So a lot of times, right, even if we get the direction right during the beginning of the week, right, maybe we've already missed the move, and maybe it's Thursday or Friday, and now we're trying to force our bias into the market. Right, Thursday or Friday, it's very unlikely to continue in our direction unless it was like an FOMC week where they were waiting for that, that midweek volatility of injection. So mining the time, obviously, when it comes to, day trading, the day of the week is highly important. It's understanding, is this week actually maxed out? Like, has this week already gone further than I expected? Because a lot of times, if we just get one sharp move, and you'll notice if you just go back and study your charts on like a CPI week that had an outsized move, the rest of the week is basically just dead. Okay? So understanding that there is a time limit on your trade idea is so important. All right. So obviously, again, when it comes to mining the time, understanding that, during the middle of the week is oftentimes going to be the best time to operate. As long as we don't have too many high impact news events in the calendar, medium impact news events on just one day, those are typically some of the cleanest, easiest trades to trade, because you're not going to get crazy whipsaw. Sometimes the bias ahead of time during the day, the previous day, is very easy to read, and you're not going to get crazy slippage when you're trying to execute your trade, or if you're trying to have your limits or stops trigger. Number 6, obviously, again, as we talked about, is having an invalidation. So as we dive deeper into some of these things, right, ICT daily bias, right, the draw on liquidity. This is a famous quote that I've read in books, or I've listened to in podcasts. It's just been cited so many times. I just wait until there's money lying in the corner, and all I have to do is go over and pick it up. I do nothing in the meantime. So the draw on liquidity is a level where price is most likely to trade to, and price will gravitate towards the area where the most trade can be facilitated. So obviously, if you think about equal highs and equal lows, well, what's resting above those equal highs or equal lows? There's pending orders in the market. That's all the market is. It's either market or limit orders. That liquidity, as the market's trading away from that level, if there are old equal highs that haven't been swept, right? more and more orders are being built up above that high. So if the market does trade to that level, there's going to be a lot of trade that they can facilitate and pair orders with before possibly going the opposite direction. So again, the draw on liquidity is going to be where the most orders are resting. If we have a large bullish imbalance, right, the market is going to gravitate back towards that imbalance to try and fill it, because maybe there's unfilled orders that the price just expanded away so fast that it didn't fill everybody's order. So there's going to be a pool of liquidity that's resting inside those imbalances or above and below those old highs. So having that draw on liquidity is obviously the first step. If you cannot determine the draw on liquidity, then we don't have a bias. You don't have to have a bias every single day. And oftentimes I don't. If the market is 50-50, I'd rather just wait for more information. If you can't determine, even with a 60-40 probability of one direction over another, there's no reason for you to be in the market. All right. It doesn't matter what the lower time frame looks like. Everything should be coming from a higher time frame perspective. So number 2 is determining the market structure. Is the market creating higher highs or higher lows, or lower highs or lower lows, or are old highs, lows being rated with speed followed by quick reversals? So obviously here we have bullish market structure, right? We have high, lower high. A high, a higher low, higher high, higher low, right here. But here is also bullish market structure, because we have this market structure in place, but we've ran it out and then quickly rejected. This, in my opinion, is stronger than this, because we've ran out and taken out sell-side liquidity. That to me is triggering a lot of orders into the market. They're trapping a lot of traders, right? And this is part of the narrative. If I see a lot of traders are trapped in here, right, and they just completely ran price away above this old high, that is still bullish market structure. All right, so understanding the different types of market structure that you might see, because this could just possibly be an intermediate or short-term low. It doesn't necessarily mean that's a long-term low. All right, because there could be a low back here where this is still a higher low compared to the previous low. All right, so we might have intermediate or short-term lows being ran out and then quick reversals. It all depends on how that price action is forming. Here, obviously is bearish example. We have high, low, lower high, lower low, lower high, lower low. But here, obviously, again, we have possibly a short-term high being ran out with a quick reversal. So reading market structure, right, will come down to how is that market responding to old highs. Are we respecting old highs or old lows and trading away from it? Or are we taking out those old highs or old lows and then trading away from it? Because, again, going back to that example with the Ukraine war, there was a lot of times where we would have sharp retracements higher, and then we would have a quick collapse. That's just indicative of a bearish trend, and that will happen continuously. It's just the way the market operates. During bearish trends, it's very likely to just plow through old highs and then completely reverse. So during bearish trends, you're going to see a lot of short-term highs being rated, and vice versa if we're in bullish trends. I would say more so during bearish trends, for some reason, we're going to take out old highs, old intermediate and short-term highs. I don't know what the case is, but bullish trends, I find them to respect old lows much more. I don't know why that is. Just comes from experience reading the markets, or maybe it's just the way I read markets, right? That's my narrative. So number 3, gauging order flow. Our PD raise, again, this is mostly ICT related. Our PD raise being respected, old highs, lows not being purged, order blocks are traded to and away from, fair value gaps traded to, not through. We don't want to see a bullish displacement and then trading through it entirely. Yes, it could trade, on a closing basis. We don't want to see it trade through that fair value gap on a closing basis. Market displacement, obviously, if we continuously see bullish or bearish market displacement, those are all signs of institutional order flow that are supporting our bias. Let's say, and also be mindful, if you have a specific bias, but then you're seeing obviously things that are going against you, well, you possibly have to, be a little bit more flexible in changing your bias. If you see, if you're bullish, right, but your bullish fair value gap is violated, and then now we're starting to put in lower highs, lower lows, and then we have bearish order blocks that are being respected, you're possibly on the wrong side, and you're not on the right side of order flow. All right. And ICT has this famous quote. Somebody had clipped it a bunch. They said, once 3 PD rays are violated, it's your ass next, and it's pretty true. All right. So number 4, factoring the news. Are there any news events that we should avoid or expect price to consolidate prior? And then, is there a specific macroeconomic narrative at play? Again, this is something that I don't think can be taught, because it really comes through you going through all these different market cycles. Like, you have to sit through a lot of different market cycles and understand how different economic conditions are factoring into the market. That's something that you can't backtest as much as people love to, as much as you would like to think that you could backtest that. In my opinion, is extremely hard unless you have a teleportation machine and you go back and actually feel the sentiment of the market. All right. Nobody really knows how people were feeling during the housing crisis unless you were actually living it, right? If you were born today and somebody tried to explain to you the housing crisis or COVID, right, how can you possibly go back and backtest that when you weren't living through it? All right, and that's something that when it comes to trading, that is, there's no shortcut for that. You just have to go through the motions. And obviously, sometimes these macroeconomic events or narratives take a really, really long time to pan out. And that's why I don't believe that people can pick up trading just within a year, right? Because it might not even be one macroeconomic cycle that you're witnessing. All right, just keep that in mind. Number 5 is mining the time. Again, weekly profiles. So when during the week do we expect the expansion to occur? And can we anticipate specific days to provide a certain daily profile? So obviously, let's say Wednesday came, we had FOMC, we put in a bullish displacement, and then Thursday we have a medium impact or one high impact news event, right? As a daily profile, we want to see price possibly trading below the daily open, and then positioning ourselves to go bullish. All right, so understanding that, specific days during the week, right? It's all dependent on, is the high impact news event where most traders or most large parties in the market are going to be comfortable putting risk on. All right. Once the narrative is out of the way, or the uncertainty of a specific news event, once that's out of the way, right, there could be very clean price action going into the next day. Again, number 6, we won't always be correct in our analysis, as we're only trading our opinion of the market, and then we have a level where our trade is no longer valid. All right, so, after bringing that up, I'm just going to pull up dollar CAD and my Telegram. So obviously in my Telegram, try and hide this. So in my Telegram, obviously this is the 4-hour chart, but if we go to the daily, it would basically be the same thing. I had a level in mind, and today we had CPI numbers out for the Canadian dollar, so I expected movement in this pair. This is my draw on liquidity up here, these equal highs, right? So anything above those highs are where we have resting orders in place, right? That's my draw on liquidity. I have this order block drawn out. I noticed that we took out short-term lows and rejected. We got this nice wick. So I basically sent this message in Telegram. I said, looking at possible run to buy side liquidity on dollar CAD, something to monitor. Now, going into today, obviously we had something that I was looking at, right? Where I'm just going to draw the midnight open, because having my daily bias, right, drawn out the night prior, and if you were to check that Telegram message, right, this was sent at 8:51 Eastern, right? So pretty much 12 hours before the news event actually occurred. I already had my bias in mind. But going into Asia, right, we already had ran higher, but we had this 1-hour inverted fair value gap down here. Now, this is where a lot of people will mess up with their daily bias, is maybe they have a plan in mind, maybe they don't. But when they get in front of the markets, right? They're basically a deer in headlights. So if I were to just replay this price action, right, this is what the market looked like prior to the news release. Okay, so when it comes to daily bias, right, again, it's being able to read the narrative, understanding that, right, we have all these runs lower, taking out short-term lows in here. We had that 4-hour order block, and we have this draw on liquidity up here. Okay, this is painting my narrative, right? The narrative is already in place. I don't need to do much more, but it's how I'm reading that narrative. Maybe you're reading that narrative incorrectly. All right, you don't see these equal highs above here, and maybe you're seeing bearish market structure, right? We have maybe these. You're looking at possibly these old highs as being lower highs in the market as we're trading lower. All right, and maybe I got it wrong, but maybe I didn't. Okay. This is where having confidence in your analysis comes into play, okay? Because guess where the best time to position yourself in the market is? As the market's going against you. As this market's going against you, who's getting the best fill on this market? Somebody that's entering long here and maybe putting their stop down here? Or is it somebody that is waiting for the move? Let's just say we get that, and now you're trying to enter it up here. Yes, you're getting the daily bias right, but you're missing the best price action. Maybe you're getting tricked. You're getting faked out because this market is trading against your bias. That's what we actually want to see. When we have a specific bias in mind, we want to see price going against us because that's going to give us the most efficient pricing. But then it comes down to discipline and confidence. Okay, having confidence in your bias, not letting other people deter you from that bias. All right, because I could go on Twitter and see a bunch of people that were possibly bearish on the dollar going into the week. Who cares? They could possibly get it right. I could possibly get it right. The difference that's gonna, have the most impact in your trading is having a plan and sticking to your plan. Because if somebody else gets it wrong and then I take a loss on it, guess who I'm gonna blame? I'm gonna blame them and not myself. So there's no learning experience there. So daily bias, again, having all those pieces of the puzzle put together and then confidently trading with that bias. So I hope you guys enjoyed this video on how to create and trade a daily bias. If you want to learn more on how to execute the trades, make sure you check out my ultimate guide to trading executions, and don't forget to subscribe to the channel for future videos. I'll see you guys in the next one.